Have you ever looked at your tax return and just wondered, how does this all work? It can feel a bit like a mystery, right? Well, today, we're going to demystify the whole thing. We're going to break down the core components of the Canadian personal income tax system, from its legal structure all the way to a real-world calculation. By the end, you'll have a solid foundational grasp on how it all fits together. Just a quick note before we dive in. This presentation was prepared by Samir Al-Rishani with AI support. Okay, let's get started on our exploration of Canadian personal income tax. So here's our roadmap for today. First, we'll look at the big picture, the actual blueprint of the tax law. Then we'll zoom in on the critical difference between income and capital, which is a game changer. After that, we'll roll up our sleeves and walk through a step-by-step calculation. And to wrap it all up, we'll touch on the human side of things, tax planning, avoidance, and evasion. Let's jump in. To really understand something as complex as the Income Tax Act, you first need to understand its structure. You wouldn't try to navigate a building without a floor plan, right? Well, it's the same idea here. This first section is all about that floor plan, the foundational structure of the Act that makes everything else make sense. You know, the Act is actually laid out in a very logical way. Think of it as a funnel. At the top, you have these broad parts, like Part 1, which deals with the main tax on income. Then it narrows down into divisions, then even further into subdivisions. Finally, you get to the most detailed level, the sections. This is where you find the specific rules and provisions we actually use. It's this hierarchy that helps us find our way through it all. Okay, so we've got the lay of the land. Now let's tackle one of the most fundamental concepts in all of taxation, the distinction between income and capital. And trust me, understanding this difference is absolutely essential because it affects nearly every single calculation we make. Way back when, income was a pretty simple idea. It meant things like your wages or profit from a business or rent from a property. But the modern tax system sees it very differently. Today, income is an all-inclusive concept. A good way to think about it is this. It's basically any increase in your financial well-being, no matter where it comes from. So if that's income, then what's capital? Well, capital is the thing that generates the income. It's the asset itself. So it could be a rental building, a stock portfolio, or business machinery. When you sell that underlying asset, the building or the stocks, you get a capital gain or loss. And here's the key. That transaction is taxed completely differently than regular income. This is where the classic tree and fruit analogy comes in, and it's just a brilliant way to see it. The tree is your capital asset. The fruit that it produces every year, that's your income. Here's the punchline. The fruit, your income, is 100% subject to tax. But if you decide to sell the tree itself and make a profit, that's a capital gain. Only half of that gain is taxable. It's a huge difference, and it's designed to encourage investment in those long-term, income-producing trees. All right, so we've defined our key terms. Now, let's get into the mechanics of how tax is actually calculated. This isn't just some random process. It's a very specific three-step framework laid out right there in the Income Tax Act. The best way to think about this is like a three-act play. Act 1 is Division B, where we add up all your income and take some deductions to find your net income. This number is really important, by the way, for a lot of government benefits. Act 2 is Division C, where we take a few more deductions to find your taxable income. And for the finale, Act 3, Division E, we apply the tax rates to that taxable income and subtract credits to find out what you actually have to pay. Now, here's something you absolutely have to remember. This is a sequential process. These steps flow into one another. The final number from Division B is the starting number for Division C, and the final number from Division C is the starting number for Division E. You can't skip a step, you can't do them out of order. Each one builds directly on the one before it. Okay, that's enough theory for now. Let's make this real. We're going to take that three-division framework we just talked about and apply it to a practical example to see how all the pieces come together with actual numbers. So let's meet our taxpayer, Miss Tammy. We're going to use her financial information for the 2025 tax year to walk through the entire calculation from start to finish. This will really help solidify how the framework operates in practice. Okay, here we go. Step 1, Division B, calculating net income. We start by adding up all of Miss Tammy's income under Section 3A. As you can see, she's got $60,000 from her job, $1,200 in interest income, and $5,000 in pension income. We add those up, and our starting subtotal is $66,200. The formula then tells us to move to Section 3B, which is for capital gains. Remember our tree and fruit analogy? This year, Ms. Tammy sold some investments and had a total capital gain of $15,000. But only half of that, or $7,500, is considered taxable. So we add that $7,500 to our subtotal, which brings us to $73,700. We're not done with Division B just yet. Now we subtract certain deductions. Under Section 3C, she can deduct $600 in moving expenses for work. And under 3D, she deducts a $3,100 loss from a side business. These deductions are allowed because they relate to the process of earning income. After subtracting those, we get to our final number for this section. And there we have it. After all that, Miss Tammy's Division B net income comes out to a nice round $70,000. This is a huge milestone in the calculation. It's this number that will now carry forward into Step 2. All right, on to Division C, where we determine her taxable income. We start with that $70,000 net income figure. Now we subtract other types of deductions. In this case, Miss Tammy has some loss carry-forwards from previous years, a $2,000 non-capital loss and a $6,000 net capital loss. The tax system essentially lets her use losses from a bad year to reduce her income in a good year like this one. So, after we subtract those loss carry-forwards, we land on Miss Tammy's final taxable income. That amount is $62,000, and this is the number that the federal tax rates will actually be applied to. This is the base for our final step. And now for the grand finale, Division E. We take her taxable income of $62,000, run it through the federal tax brackets, and let's assume that gives us a tax bill of $10,511. But we're not done. We then subtract her non-refundable tax credits, which total $4,764. These credits, for things like the basic personal amount, reduce her tax dollar for dollar, leaving a final federal tax payable of $5,747. So we've walked through the mechanics, the numbers, the whole calculation. But of course, there's always a human element, isn't there? The tax system isn't just a set of rules. It's also about how people choose to interact with those rules. And those approaches can be very, very different. It is so important to understand the lines between these three things. Tax planning is completely legal. That's just arranging your finances smartly to minimize tax, like making an RRSP contribution. Tax evasion is the opposite end of the spectrum. It's illegal. It's hiding income, claiming fake expenses. It's a criminal offense. And then you have this murky gray area in the middle called tax avoidance, which might be technically legal but goes against the spirit of the law. And that's a risky place to be because the CRA can and will challenge it. And really, that brings us to the final, critical question that sits at the heart of so much tax debate. Where exactly do we draw that line between smart, legitimate planning and aggressive avoidance that just goes too far? There's no easy answer. It's a constant point of tension for taxpayers, for professionals, and for the government itself. Thank you so much for joining me today. I hope this gave you a clearer picture of our tax system.